right, another Mortgage Monday, and I want to talk about debt to income ratio. So there are two. There's a housing and a total debt to income ratio, okay? FHA mortgages can go up to a 56.9 total debt ratio, and they can go up to a 46.9 housing ratio. Some of you say no, but yes, I can, okay? As long as I usually get a DULP approval, we can explain what those are at a later date. Now, the way debt to income ratio is figured up is they're going to take what your proposed mortgage payment is, and they're gonna figure out what percentage of that it takes up of your gross income. For W-2 borrowers, self-employed, it's a different story. But it's gonna figure out what percentage of your income that it takes up, meaning that your new mortgage payment can't be greater than 46.9% of what your income is. Now, total debt ratio takes up all of the debt that's on your credit, consumer credit, not utilities, not anything like that. Let's talk about credit cards, student loans, car payments, all that good stuff, right? And including child support, alimony, that does come into play too, okay? Then your total debt ratio, which you can't exceed on FHA, is 56.9, meaning that your new housing payment, including taxes, insurance, HOA, not utilities, and all the consumer credit that you have, debts on your credit, cannot take up over 56.9 of what your income is, okay? That's kind of how that works. A lot of lenders put out misinformation, or when you go online, you see 31 and 43 for FHA. That's not actually true. And then for conventional, I can get people approved all the way up to a 50% debt ratio, whether it's on housing or on total debt to income, okay? Jumbos are a different story. They're usually much lower. They usually want things below 45%. I can go higher in some cases. And then VA is interesting. There is no debt to income ratio restrictions on VA. I've actually qualified people with like a 73, 76% debt to income ratio. It's based off residual income. Residual income, some of you may go, oh, that's just not right lending to somebody with that high of a debt ratio. Actually, I'd like to argue with you on that, because residual income calculates everything, including your taxes and insurance coming out of your paycheck, and maintenance on the property. Says you have this much residual income left over. That's real money that they're saying after all of this other stuff that you have to put in your bank account and be comfortable. Well, guess what? VA has the lowest foreclosure percentage out of any loan out there. So guess what? A 73% debt ratio can be a good thing. So that's a brief overlay of how everything works when it comes to debt to income ratio.